Hello all, this is Aman from Canada. Welcome back to the part 4 of the Fast 5 series. Under this series, we release one video every Sunday answering 5 most frequently asked questions by the study abroad community. If you have any question that you want answer on regarding abroad education loan, you can put it in the comment below and we will take it up in the next video. Before we start, I would like to remind you to subscribe to this channel so that the next video when we release, you can watch it as well. So let's start. Sorry to say this, but there is no best bank to take an abroad education loan. The answer to this question depends on your profile. I can give you a basic framework with which you can decide which is the best bank/lender for your education loan request. So how do you analyze this? First, you need to analyze that whether you have the collateral or not. If you have the collateral, then go with the public sector banks, because public sector banks give the lowest interest education loan. The difference between a public sector education loan and a private sector education loan is of 2 to 3%. You can get a public sector education loan at approximately 8% or 8.5%, whereas a private sector education loan will start approximately at the rate 10 or 10.5%. So that is the first question that you need to answer, whether you have the collateral or not. Now, if you don't have the collateral, there you need to decide between banks and NBFC. Go with the banks if you are eligible for the unsecured education loan from the bank. There are only a couple of banks in the market who give unsecured education loan of more than 7.5 lakh rupees. If you are not eligible for an unsecured education loan from the bank, then opt for the loan from the NBFC. There, the difference between the bank and NBFC would be that the unsecured loan from the bank will be at a lower rate of interest than the unsecured loan from the NBFC. Now, even if you are not eligible for an education loan from the private bank or from a private NBFC, in that case, you can opt for international lenders. The international lender can approve education loans for certain colleges and countries without collateral and without co-applicant. So this is the basic framework you need to follow. First, check if you have the collateral, go with the public sector banks. If you don't have the collateral, decide between bank or NBFC. If you are not eligible either from the bank or from the NBFC, then go for the international lender. I can understand that this can be overwhelming and confusing. That's why you can get in touch with us by clicking on the link below. That's a very interesting question. Why would somebody take a loan when they have the money, especially for their own education? There are two answers to that. The first is, it depends on how much money you have. Let's say if you have money which you have kept aside for the rainy day, or put it in another way, if you put that money in your education, you won't have anything for a personal emergency or any kind of other emergency, then that is not the situation you want to be in. So primarily the savings you have, if you have the little savings, then you can put it as for the emergency purpose, emergency uses, and take a loan from the bank for your education. Now, if you don't have the little money, if you have saved a lot, even after that, taking education loan can make sense. How? So how much interest do you pay when you take an education loan? 8 to 10%, right? If you take it from public sector bank, it will be 8%. If you take it from the private NBFCs, it will be 10, 11%, 12%. Now, if you are a smart investor, what you can do is you can invest that money in some financial instrument like stocks, mutual fund. And if you know, or if you have been doing that in the past, that you can make 20, 15, 18, 19% return greater than what is the interest that you are going to pay to the bank, then you will end up making more money, right, by using the loan from the bank. Not only that, you also get the tax benefit on the interest that you pay to the bank. That means your cost of fund will not be 10% if you take it from the bank. If let's assume your interest rate is 10%, your cost of fund will be 7%, assuming you are in a 30% tax bracket. So in a way, you can get money at 7% from the bank, invest it in your education, and put your money in some other financial instrument where you are getting 12, 15, 18 or 20%. And that's a smart investment choice. These are the reasons why you should take an education loan even if you have your fund yourselves. So that's a very interesting question. The answer to that depends on two things. First is which kind of lender you are taking a loan from. So if you are taking a loan from public sector banks, usually they don't mandate it. It's your choice. If you want to take in loan insurance, you can. If you don't want to take, you are not forced to do so. Like banks like State Bank of India, they give you discount on the interest rate if you buy a loan insurance. But again, they don't mandate it. On the other hand, if you're taking a loan from private banks, private institutions, they mandate it. So there mandatorily you will have to buy the loan insurance. Now, what do we recommend? We recommend that you should take the loan insurance. Why? God forbid, if any personal emergency happens and you are no more. In that case, if you have the loan insurance, that money will be paid by the insurance company to the lender. The obligation to pay that money won't come to your parents, to your cooperative. You should take the loan insurance in the same way you take the normal insurance, right? That if something happens to you, then your family is being taken care of. At the same time, here because you have taken an obligation, and in almost all the loans, your parents are your co-applicant. If something happens to you, then your parents will have to pay that money if you don't have the loan insurance. So we recommend you to buy a loan insurance irrespective of if it is being mandated by the lender or not. If you want to know more about these loan insurances and how this works, get in touch with our education loan counselor. I would like to give a very practical answer to this question. So usually when you do MBBS from India, you have to spend an upwards of 40-50 lakh rupees. No bank or no lender will give you an unsecured loan for MBBS of 40 to 50 lakh rupees. The reason is very simple, because after MBBS people usually go for other studies, higher education, and banks are not very clear or very confident if you will start earning immediately. They know that you will earn good, but they don't know when you will earn good. That's why they don't want to be in a situation where you want to go for a higher education, but you are doing a job just to repay the education loan taken by the bank. Now, if you are doing MBBS from abroad, again you won't be able to get an unsecured education loan. The primary reason for that is the MBBS that you do from the other country, as you know, are not valid in India to practice unless you pass the qualification exam that they've kept it for such condition where you do the MBBS abroad. And that's an if condition, and lenders generally don't like if condition. That's why they won't give you an unsecured education loan to study abroad, or in fact to study in India of a very high amount. In general, up to 7.5 lakh rupees you can take, but I know that is not sufficient for any kind of MBBS. So if you have taken a personal loan and have been paying the EMIs on time, that will improve your CIBIL score, that will give you, the lender, more confidence in approving your education loan, be it with collateral or without collateral. If you have taken a personal loan and if you have not paid EMIs on time, or there has been even a general delay of couple of days, 5 days, 10 days in repaying the EMIs, that affects your CIBIL score badly, and the new lender won't want to take a higher risk of 30 to 40 lakh rupees on your profile. So if you have taken a personal loan, it really depends on whether you are repaying the EMIs on time or not. That's the first factor. Second is how much loan amount you have taken. So let's say if you have taken a very small amount of 30,000, 40,000, 1 lakh rupees, which is insignificant in front of the amount you are applying for, 40 lakh rupees, 50 lakh rupees. In that case, they might ignore the loan that you already have. But let's say if you have taken a personal loan of 8 to 10 lakh rupees, which is a very high obligation already on you, and you are supposed to pay a higher amount EMI, they will do is they will ask you to close your personal loan first and then do another loan on the top of that. Or they will ask you to add a very strong co-applicant with the very strong earning potential, who can not only cover your personal loan EMI but also your education loan EMI. It's many if and buts, so better to talk to a loan counselor by checking the loan eligibility on the link below. I hope that answers your question.